The United States Senate is entering a decisive phase in shaping the future of digital asset regulation through the Clarity Act. This legislation aims to bring long-awaited legal certainty to cryptocurrencies, stablecoins, and blockchain-based financial systems. For years, the industry has operated under fragmented enforcement, where regulatory agencies often relied on interpretation rather than clear statutory guidance. The Clarity Act seeks to replace that uncertainty with a structured legal framework. Senator Bernie Moreno has emphasized that bipartisan momentum is finally aligning behind this effort. According to him, the Senate is preparing for a formal markup process, which is a key legislative step where the bill is reviewed, amended, and refined. This stage is critical because it determines the final shape of the legislation before it reaches the full Senate floor. If successful, the Clarity Act could redefine how digital assets are classified in the United States. One of the biggest goals is to clearly separate the jurisdiction of regulatory bodies, such as the SEC and the CFTC. This distinction is essential because it determines whether a digital asset is treated as a security or a commodity, a debate that has created years of legal confusion. However, the legislative path is complex. The bill must pass through multiple committees, each with its own priorities and concerns. Even after Senate approval, the bill may need to return to the House if substantial changes are made. This multi-step process makes the timeline uncertain, even though political momentum appears strong. Despite challenges, many lawmakers believe this is the closest the United States has come to establishing comprehensive crypto regulation. If passed, the Clarity Act could position America as a global leader in blockchain governance. The Clarity Act has sparked one of the most intense debates in modern financial policy, particularly around the issue of stablecoin yield and its impact on traditional banking systems. Banking institutions across the United States have expressed concern that allowing yield on stablecoins could lead to significant movement of deposits away from conventional banks. Their argument is centered on financial stability. Banks rely on deposits as a primary source of lending capital, which supports mortgages, small business loans, and agricultural financing. If large amounts of money shift into stablecoins offering higher returns, it could reduce the lending capacity of banks and potentially affect the broader economy. Major banking associations have formally urged lawmakers to strengthen restrictions within the bill. They argue that even moderate changes in deposit flows could have long-term consequences for credit availability. Their position is that financial innovation should not compromise systemic stability. On the other hand, crypto advocates argue that the banking sector is resisting necessary innovation. They believe that stablecoin yield represents a natural evolution of financial services, allowing consumers to earn better returns on their money. From their perspective, competition is essential for progress, and restricting yield would protect outdated financial models. This disagreement has created a major policy divide, making stablecoin regulation one of the most controversial aspects of the Clarity Act. A notable internal divide has emerged within the banking industry itself regarding the Clarity Act. Large national banks with significant consumer deposit exposure are strongly opposed to stablecoin yield mechanisms. Their primary concern is that digital assets could divert large amount of capital away from traditional savings accounts, affecting their lending operations. In contrast, smaller community banks have shown a more flexible stance. These institutions often operate at a regional level and may not face the same systemic risks associated with large-scale deposit migration. As a result, some community banking representatives have expressed willingness to engage with a more balanced regulatory framework. This split is influencing the political process in Washington. Lawmakers are receiving conflicting feedback from different segments of the banking industry, making it more difficult to reach consensus. In some cases, this has led to competing lobbying efforts aimed at shaping specific provisions within the bill. The situation highlights a broader transformation occurring in the financial system. Traditional banking institutions are increasingly being challenged by decentralized financial technologies that operate outside conventional infrastructure. This shift is forcing regulators to rethink how financial stability and innovation can coexist. As negotiations continue, this internal banking divide is expected to play a significant role in shaping the final version of the Clarity Act. Senators Thom Tillis and Angela Alsobrooks have played a central role in attempting to bridge the gap between competing interests in the Clarity Act. Their compromise focuses on stablecoin reward structures, aiming to prevent digital assets from directly replicating traditional bank interest systems. Under their proposal, stablecoin issuers will be restricted from offering direct interest-like returns that could resemble bank savings accounts. However, the framework still allows alternative forms of incentives that do not directly mirror traditional financial products. These may include ecosystem-based rewards or platform-specific benefits. Supporters of this approach argue that it strikes a necessary balance. It protects the banking system from rapid deposit outflows, while still allowing innovation in digital finance. They believe that a complete prohibition would be too restrictive and could slow technological development in the United States. Critics, however, remain divided. Banking groups argue that indirect yield mechanisms could still create similar risks, while crypto advocates believe the restrictions are unnecessary and limit consumer choice. Despite disagreements, lawmakers continue to push for a compromise that can secure bipartisan support and move the legislation forward. Market structure reform is one of the foundational pillars of the Clarity Act and may ultimately define its long-term impact on the U.S. financial system. The primary objective is to eliminate regulatory ambiguity by clearly defining how digital assets are classified and overseen. For years, crypto companies have faced uncertainty due to overlapping jurisdiction between regulatory agencies, such as the Securities and Exchange Commission and the Commodity Futures Trading Commission. This has led to inconsistent enforcement actions and legal disputes, making it difficult for businesses to operate with confidence. The Clarity Act seeks to resolve this by assigning clear regulatory responsibilities. This will provide certainty for exchanges, developers, and institutional investors, allowing them to operate within a well-defined legal framework. Supporters argue that this clarity is essential for attracting institutional capital and fostering innovation. However, achieving this level of clarity requires careful legislative drafting. Regulators must balance investor protection with technological flexibility, ensuring that rules are strong enough to prevent abuse while not stifling innovation. Industry leaders believe that without this reform, the United States risks falling behind other regions that are moving faster in establishing digital asset regulations. As a result, market structure reform has become one of the most closely watched elements of the entire bill. The Clarity Act has revealed deep divisions not only within the banking sector, but also among policymakers and industry stakeholders. While some view the bill as a necessary step toward regulatory clarity, others see it as an incomplete compromise that may still leave gaps in enforcement. Reporter insights suggest that negotiations are still active behind the scenes, particularly around stablecoin language. Some lawmakers believe the issue has been largely resolved, while industry representatives argue that the current draft still allows indirect yield structures to exist. This disagreement reflects a broader challenge in financial regulation, balancing innovation with systemic risk management. Crypto markets evolve rapidly, while legislative processes are inherently slow and deliberate. This mismatch creates tension during policy formation. Lobbying efforts are expected to intensify as the bill approaches formal markup. Both banking groups and crypto organizations are actively engaging with lawmakers to influence final wording. As a result, the Clarity Act remains a dynamic and evolving piece of legislation, with outcomes that are still far from guaranteed. The timeline for the Clarity Act remains ambitious, with lawmakers aiming to advance the bill through committee stages before the summer legislative window. However, the process is subject to multiple procedural and political variables that could affect timing. Each stage of the legislative process introduces potential delays. Committee markups, amendments, and interchamber negotiations all add complexity. Additionally, bipartisan cooperation, while improving, is still not guaranteed on every provision. Political analysts note that external factors, such as economic conditions and election cycles, could also influence the bill's progress. Lawmakers may adjust their positions based on voter sentiment and industry pressure. Despite these uncertainties, there is a growing sense that momentum is stronger than in previous attempts to regulate the crypto industry. Many stakeholders believe this is the most serious legislative effort to date. The coming months will be critical in determining whether the Clarity Act can move from proposal to law. The broader narrative surrounding the Clarity Act reflects a major shift in United States financial policy from enforcement-driven regulation towards structured legislative frameworks. For years, the crypto industry has operated under regulatory uncertainty, where enforcement actions often define boundaries instead of clear laws. Industry leaders argue that this approach created confusion and discouraged institutional participation. Without clear guidelines, companies face legal risks that slowed innovation and investment. The Clarity Act aims to address these concerns by establishing a consistent national framework. This shift is particularly important for institutional investors who require regulatory certainty before committing large amounts of capital. Clear rules could unlock significant inflows into digital asset markets and strengthen the United States' position in global financial innovation. At the same time, regulators emphasize the need to maintain strong oversight to prevent fraud, manipulation, and systemic risk. The challenge lies in creating a framework that supports growth while maintaining market integrity. As discussions continue, the Clarity Act is increasingly seen as a turning point in U.S. crypto policy. Industry reactions to the Clarity Act have been mixed, reflecting the complexity of the legislation and the diverse interests involved. Some stakeholders view the bill as a significant step forward, while others believe it does not go far enough in addressing key issues. Crypto executives have expressed cautious optimism, noting that even imperfect regulation is preferable to continued uncertainty. They argue that clear rules, even with compromises, will provide a foundation for long-term growth and innovation. On the banking side, concerns remain focused on deposit stability and lending capacity. Financial institutions are closely monitoring the bill's language to ensure that it does not unintentionally disrupt traditional banking operations. Interestingly, opposition to the bill is coming from multiple directions for different reasons, which is common in large-scale legislative efforts. This reflects the difficulty of balancing competing priorities within a single framework. Despite disagreements, there is broad acknowledgement that regulatory clarity is necessary. Even a consensus on the details remains difficult to achieve. As the Clarity Act moves closer to formal Senate consideration, political stakes are increasing significantly. Lawmakers are aware that the outcome of this legislation could shape the future of digital finance in the United States for decades. The bill represents more than just crypto regulation. It reflects a broader debate about how innovation should be governed in a rapidly evolving financial landscape. Supporters argue that the United States must lead in blockchain technology or risk falling behind global competitors. Opponents, however, caution that rushed legislation could create unintended consequences for the banking system and broader economy. This tension between speed and caution is central to ongoing negotiations. With markup expected soon, attention is now focused on whether bipartisan agreement can be maintained to the final stages of the legislative process. The coming decisions will determine whether the Clarity Act becomes a landmark law or another stalled attempt at crypto regulation. The Clarity Act is increasingly being viewed as a foundational moment for U.S. digital asset regulation. Policymakers are attempting to bring structure to an industry that has grown rapidly without a unified federal framework. For years, companies in the crypto space have operated under overlapping and sometimes conflicting interpretations of existing laws, leading to uncertainty in compliance and innovation planning. This legislation seeks to replace that fragmented system with clear definitions and regulatory boundaries. By doing so, it aims to reduce legal ambiguity and create a more predictable environment for businesses and investors. Supporters of the bill argue that this predictability is essential for long-term industry growth and for attracting institutional capital into blockchain-based markets. At the same time, regulators are emphasizing the need for strong safeguards to protect consumers and maintain market integrity. The challenge lies in designing rules that are flexible enough to accommodate technological evolution while still ensuring accountability. As discussions continue, the Clarity Act is being framed not just as a crypto bill, but as a broader modernization of financial regulation in the United States. One of the most important structural goals of the Clarity Act is to resolve long-standing jurisdictional disputes between major regulatory agencies in the United States. For years, uncertainty between agencies such as the SEC and CFTC has created confusion over how different digital assets should be classified and regulated. This ambiguity has led to inconsistent enforcement actions, with similar projects sometimes facing different regulatory interpretations depending on the agency involved. The Clarity Act aims to eliminate this inconsistency by clearly assigning responsibilities and defining asset categories. By establishing a unified framework, lawmakers hope to create a more stable regulatory environment where businesses understand the rules before entering the market. This clarity is expected to reduce legal disputes and encourage innovation in blockchain technology. However, achieving this level of coordination between agencies is complex and requires careful legislative drafting to avoid creating new overlaps or gaps in oversight. Stablecoin regulation remains one of the most sensitive and debated components of the Clarity Act. These digital assets, which are typically pegged to fiat currencies like the US dollar, play a critical role in the broader crypto ecosystem by providing liquidity and stability. The main concern raised by traditional financial institutions is the potential impact of stablecoin yield mechanisms on bank deposits. If users can earn returns through stablecoin platforms, there is a risk that funds may shift away from traditional savings accounts. This could, in theory, reduce the capital available for lending in the banking system, affecting mortgages, small business loans, and other forms of credit. As a result, banking groups are pushing for stricter rules to limit or prohibit yield-like features. On the other hand, crypto advocates argue that stablecoin innovation enhances financial competition and provides consumers with more efficient alternatives. They believe that restricting these features could slow down technological progress and limit financial inclusion. This ongoing disagreement continues to shape negotiations around the bill. The banking industry's response to the Clarity Act has highlighted a deeper concern about financial system stability in the face of rapid technological change. Large financial institutions, in particular, are focused on maintaining deposit levels that support their lending operations. Their argument is that even a small shift in deposits toward digital assets could have a meaningful impact on credit availability. This concern has led to strong lobbying efforts aimed at tightening the language around stablecoin rewards and related mechanisms. However, smaller banks and fintech-friendly institutions are more open to gradual integration of blockchain-based financial tools. They see potential opportunities for collaboration rather than competition. This divergence within the banking sector is creating complexity for lawmakers who must balance competing economic interests while drafting legislation that applies at a national level. The outcome of this debate will likely influence how traditional banking and decentralized finance coexist in the future. Political negotiations surrounding the Clarity Act are increasingly focused on compromise language that can satisfy both innovation-driven stakeholders and risk-averse financial institutions. Senators involved in drafting the bill are working to refine provisions related to stablecoin rewards, market classification, and regulatory oversight. The goal is to create a framework that is strict enough to ensure financial stability, while still flexible enough to allow technological development. This balancing act is at the core of ongoing discussions in Washington. Lawmakers recognize that an overly restrictive approach could push innovation offshore, while a lack of regulation could expose consumers and markets to unnecessary risks. As a result, the bill is being carefully adjusted to find a middle path. Despite disagreements, there is growing recognition that some form of compromise is necessary to move the legislation forward in a bipartisan manner. Market structure reform continues to be one of the central pillars of the Clarity Act. The primary objective is to establish clear legal definitions for digital assets and determine how they should be regulated under federal law. This includes addressing whether certain tokens should be classified as securities or commodities, a distinction that has significant implications for how they are traded and supervised. Clear classification would reduce uncertainty for exchanges, developers, and institutional investors. The bill also seeks to streamline regulatory oversight by reducing overlap between agencies. This would help create a more efficient and predictable compliance environment for market participants. Industry leaders have long argued that regulatory clarity is essential for attracting long-term investment into the United States. Without it, companies may choose to operate in jurisdictions with clearer rules. As a result, market structure reform is seen as a critical step towards strengthening America's position in global digital finance. The legislative process of the Clarity Act remains highly dynamic, with ongoing negotiations continuing behind closed doors. While public statements from lawmakers often emphasize progress, internal discussions reveal that several key issues are still unresolved. One of the main challenges is aligning the interests of multiple stakeholders, including banks, crypto companies, regulators, and consumer advocacy groups. Each group has different priorities, making consensus difficult to achieve. In addition, the technical complexity of the legislation adds another layer of difficulty. Defining digital assets in legal terms requires precision to avoid unintended loopholes or enforcement challenges. Despite these obstacles, there's a shared understanding that regulatory clarity is necessary. The disagreement lies in how that clarity should be achieved and what trade-offs are acceptable. This ongoing negotiation process reflects the complexity of integrating new financial technologies into existing legal frameworks. The global implications of the Clarity Act are also becoming increasingly significant. If passed, the legislation could set a precedent for how other countries approach cryptocurrency regulation and blockchain governance. Many international observers are closely monitoring developments in the United States, as its regulatory decisions often influence global financial standards. A clear and structured framework could encourage other nations to adopt similar approaches. At the same time, there is competition between countries to attract blockchain innovation and investment. Jurisdictions with clearer rules may have an advantage in hosting crypto companies and financial technology firms. This global context adds pressure on U.S. lawmakers to finalize legislation that not only works domestically, but also maintains international competitiveness. As a result, the Clarity Act is being viewed as part of a larger global regulatory evolution. Investor sentiment around the Clarity Act is cautiously optimistic. Many market participants believe that even partial regulatory clarity could significantly improve confidence in the digital asset sector. Institutional investors, in particular, have been waiting for a clear legal framework before committing larger allocations to crypto markets. Uncertainty around regulation has been one of the main barriers to entry for traditional financial institutions. If the Clarity Act successfully defines asset classification and regulatory oversight, it could unlock new capital flows into the industry. This includes both direct investment in digital assets and infrastructure development. However, investors are also aware that the legislative process is not guaranteed. Political delays or unresolved disputes could still impact timelines and outcomes. As a result, market participants are closely monitoring every stage of the bill's progress. The Clarity Act represents a pivotal moment in the evolution of U.S. financial regulation. Whether it succeeds or faces delays, it has already sparked a national conversation about the future of money, technology, and innovation. Lawmakers, regulators, and industry leaders are all engaged in shaping a framework that could define the next generation of financial systems. The outcome will likely influence not only the crypto industry, but also the broader structure of digital finance. As the bill moves forward, attention will remain focused on key issues such as stablecoin regulation, market structure reform, and interagency coordination. Each of these elements carries significant implications for how the financial system evolves. In many ways, the Clarity Act is more than just legislation. It is a test of how the United States adapts to technological change while maintaining economic stability and global leadership.